Welcome to our class, Financial Management. We will be looking at working capital management. Now, by the end of this class, we should be able to appreciate the importance of working capital in corporate finance. This is one of the major topics that you'll find in your second level. It is important to understand what working capital is for the different types of businesses that exist for a sole trader, for a partnership, as well as a company. We're also going to identify the types of working capital policies and their effects. We will later on discuss how to finance working capital and also evaluate the problem of overtrading and also its consequences. Finally, we will also consider the approaches to managing stocks, debtors, and cash. So to start with, we are going to quickly look at the definition of key terms here. Under working capital simply refers to the financing, the investment, the control of net assets within the given policy guidelines. So working capital comes in these two types as what we call the gross working capital. This is the net assets, the current assets. So the current assets we know the easily convertible assets into cash, like cash, bank, the inventory, the prepayment, the trade receivables. So the gross working capital is also the current assets. And we also have what is called the net working capital, which is the difference between the current assets and the current liabilities. So gross is before we deduct the current liabilities. So working capital has been presented in two forms. The gross, that is just the current assets themselves. Then when we remove the current liabilities, it becomes the net working capital. So if we're going to go to our quiz, we will reflect to the gross working capital as what? The current assets. So this is what makes the gross working capital. Okay, so why does working capital matter? Why is working capital important, especially to businesses? Number one, without working capital, a business cannot operate. It is actually this working capital that most of these small firms rely on. Please, our rules of engagement is when you join, mute yourselves. So usually, working capital is a significant part of the assets. In some cases, most of the companies are required to have at least 50% of their working capital to compose of their total assets. So the working capital must be at least more than 50%. And those of you who would be endeavoring to doing researches, there's a research you can do, the impact of working capital on SMEs. Working capital also involves key company activities such as purchasing, production, and selling. So working capital also matters in terms of uncertainties. It is important for production uncertainties, sales uncertainties, material delivery uncertainties. It's important that working capital is understood by the various businesses that exist. So there is a need to manage working capital to reduce the risks that are involved in business, such as liquidity risks. Now, what are liquidity risks? They are risks to do with short-term debt obligations. So the composition of working capital is been given here. So the gross working capital we've already established are simply the what? The current assets. Then when we subtract our current liabilities, we get what we call our net working capital. So the gross working capital is simply the current assets. There's also another key term under working capital management, which we call the cash operating cycle. This is simply the length of time between a company's cash payment for the purchases, labor, and other production expenses, and their receipts from the sales. So, in short, what we are talking about when we are discussing the cash working, the cash operating cycle, it is simply the amount of time um, cash is tied to the working capital. So we have what we call the working capital cash cycle. So this is a brief cycle through which working capital hovers around. So cash can move in the following ways. It is held up into raw materials. Cash can also be held up in what are called payables through our debtors. And the raw materials here are processed through what we call production. And production goes through 3 to 4 key stages. So for a finished product to be attained, it will partially be produced into what we call work in progress. Work in progress could be if you are, for instance, dealing with bicycle manufacturing. You are done with the hub, you don't have the wheels. So when the end of the year elapses and the bicycle is not complete without the brakes, and we call that work in progress. It is not yet a finished product. So it has to go into what are called um, uh, process stages. So when it's taken into another process, other additives are added in the production process until we have what we call the finished product or the finished good. When the good is finished, it undergoes the sales and marketing department where the goods are sold to the people we call our debtors. So these debtors are the ones who hold our money in terms of goods. And through the marketing department, we now collect our monies. These are the collections. So we have our monies in terms of cash. This cash can now be paid out to our creditors, the people we owed money. So these creditors are paid their monies for us to get the raw materials. So the creditors are the ones who supply firms the goods or raw materials that are used in production. The raw materials are again taken to production, the work in progress, and the production process goes on until the finished goods are attained in a firm, which are sold to the marketing department. These are converted into trade receivables or trade debtors. And these trade debtors are the ones who now will pay us back. So there's what we call the collection period and the payment period. So this was done mainly under what we call the ratio analysis. So this is how monies hover around in what we call the cash operating cycle, the COC. So to calculate the cash operating cycle is what we call the stock period. We add what we call the customer credit period. Then we subtract what we call the supplier credit period. So to calculate the time, like we said, the cash operating cycle is simply the amount of time our cash is tied into working capital. The amount of time it takes us to convert our production back into cash. So it starts first by calculating the stock period. Okay, how long it takes for us to have our stock held up into the company, either as a tied up inventory or in the production cycle from raw materials into a sellable good. We also add the time it takes for our customers to pay back our monies, minus the time it takes us to pay our creditors and money. So to calculate that, there's what we call the stock period. Okay, the stock period is simply the stocks that we have over the cost of sales times 365, the time in short it takes for us to sell the stock. Then we also have what we call the customer credit period. This is simply the time it takes for us in days to pay our what? To collect our money, the collection period in short. Then we also have the supplier's credit period, which is simply the time it takes for us to pay our suppliers. So, with what has been given, we now will need to calculate from the quiz that um, period of time. So I want you to get your calculators, write down that formula that I've given you just now. Write down the formula that I've just given you now so that we calculate together. Write down the formula there. I want us to all move together. I want you to understand, ideally, this is how this must be done. You need to understand how these calculations are done other than just copying. Okay. So we want to calculate what is called um, the what is the cash operating cycle in days. So what are we given from the data that we have? We've been given the trade debtors, the amount of trade debtors as what? 100, trade creditors as 70, and our sales, the turnover stands for the sales, which is 500,000. Then we have what we call the cost of sales, the operating profit, and the interest expense will not be used in this case. It may just be used to confuse you if you don't know what you're doing. Then we have stocks as well, which is 90,000. So we want to calculate the cash operating cycle. Okay, now what is the formula for the cash operating cycle? Somebody?
For the what?
The cash operating cycle. What is the formula?
Stock period plus customer credit period minus the supplier credit period.
Great. The stock period plus the customer credit period minus the supplier period. So now we'll start calculating our stock period in days. Then we've got the customer credit period in days. So we are going to calculate stock over cost of sales times 365. Then the debtors over sales times 365. Let's calculate. Let's go there. Uh-huh.
That's 90,000 by 365 over 300,000.
90 by 365. 90 over what?
90,000 by 360 over 300,000.
Are you sure?
Yes. Have we not been given the cost of sales as 300,000?
Yes. It's 90 over 300, not 365. Eh? 90 over?
90 by. Are we not multiplying by the 365?
Yes, by 365. Okay, good.
Mm.
So what are you getting here?
109.5.
09.5. So what do we call this? This is called the what?
The stock period.
The stop
Days.
period. Good. Somebody also calculate the other part. What other part of the component are calculating? The customer credit period. So this is data as over sales times 365. What do we have?
100 times 365 over 500,
100
or 100,000 divided by 500,000 times 365.
okay, times 365. What are we getting?
73.
73. Okay. Then the last part is what? We're subtracting the last part, which is the supplier credit
The
period.
supplier credit period.
So the supplier credit period is what? Credit the creditors over the cost of sales times 365.
Oh,
So what is our credit?
70,000
Mm-hmm.
over 300,000 times 365
What are we getting?
times 365. We are getting 85.166 or 85.17, something like that.
So this one we are subtracting. So what are we getting?
The total
Mhm. This plus what?
97.3. 97.3.
What is our answer in this case?
97.
97. So this is what we call our
No, there are two answers there. Oh, the other one is negative. Okay.
The other one is negative.
Okay, so we're talking about the period it takes. All right. So these are the example. The same application. You can do that.
So Collins,
Uh-huh.
when we say 97, are we supposed to put a unit there? Are we supposed to say 97 days, or we just leave it at 97 just like
In
that?
days, because 365
In,
is in days, yeah. So 97
oh,
days. It's a
okay.
period in days. Okay. So it's 97 days. Thank you. All right. So this is how we calculate. Now, working capital has policies. Now, these policies are all related to the management of working capital. Now, these policies, number one, they will cover the level of cash and stock. They also cover the credit terms for the customer and the credit terms for the supplier. So you may have a working capital policy that will ensure that um, the regulations that are imbued in it benefit the shareholders themselves in enhancing their shareholder value, and also they help influence what are called the future returns associated to risks. They're mainly put into a document that ensures that whoever is managing the stock follows the policies that are put in place. Now, questions: if working capital policy is ineffective, what becomes of the firm in terms of growth and profitability? So it is important to ensure that the policies that are set up by a firm are firm. Once they're ineffective, they one jeopardize the growth of the firm in terms of profitability. They also increase what is called liquidity risk. Liquidity risk comes about in the firm's inability to paying their short-term obligations. They'll be in default. Working capital is very important, especially for sole traders, because it helps them really strategize and plan how they're going to meet their debts. It also ensures that there's no overtrading problem. What is overtrading, if I may ask? Anyone? What do you understand by overtrading? In your own.
Could it be oversupplying of goods or services, something like that?
Okay. Yes, it's mainly refers to excessive buying and selling of stock um, without putting in place financial strategies. You're just, in short, trading without considering the growth of the business. You know, even when you're buying, you need to buy with strategy. So overtrading simply comes about when the firm is overbuying and selling, either by a broker or the individual trader. So it has its own repercussions. Okay, so this is what comes about if there is no effective working capital policy. So working capital policies also influence the level um, of strategies that will be put in place. So working capital has mainly two kinds of strategies. There's what we call the aggressive and the relaxed strategy. So when you're dealing with the aggressive strategy, here we're operating with lower levels of working capital. Under aggressive approach, there's increased profitability, there's low cost of working capital, and there's a high risk associated to it. When you're dealing with a relaxed approach, here you're operating with high levels of stock that are that have extended credit terms and high cash and marketable securities that can be turned into cash quickly. Under a relaxed approach, it is associated with low risk. It's actually the opposite of this. In an aggressive approach, we have what we call high risk and low cost of working capital. Here we have low risk, which attracts more customers, and there's high cost of tying up working capital in stocks. Now, with these two strategies, there is a concept that we call EOQ. The EOQ is the level of stock that a firm must keep to remain in business. It is sometimes costly for firms to keep too much stock or to also have little or no stock at all. So, working capital has what are called accompanying costs that are attached to it. And these costs, I'm going to break them down quickly as follows. There's what we call carrying costs. Now, this is a working capital cost that is associated with the storage of stock, with the handling costs of stock, with the opportunity cost of holding stock. Now, when a firm decides to hold stock or to carry stock, there are associated costs that are inevitable. You know, when you're trading, you need to strike a balance. There's what we call a level of safety that a firm must consider when keeping stock. Too much stock may be too dangerous, and too little stock may be too dangerous. So there's what we call a carrying stock, which has the following. Number one, we have what we call storage costs. So when you're keeping um, stock, there's obviously some cost that is attached to you holding it, you carrying it, you storing it. What kinds of stocks are associated to storage, if I may ask from you people? What do we mean by storage and handling costs? What do we mean by opportunity cost of holding in your own words?
Okay, maybe let me try for handling costs for
Mm-hmm.
store. I think this could be costs that are incurred as you are trying to move goods from one warehouse or one place to the other. Now that cost of you moving them is maybe what we call as handling cost.
Yes, but how is it a cost? Yes, that's very correct.
It is a cost because it is an addition to the actual it's an addition to the actual product of where you're trying to move it from where it was maybe produced to where it would actually be accessed by others.
Yes, so when are dealing with current costs, of course, these current costs are also called holding costs. So when we're dealing with the formula down there, we use the letter C or H. These are also known as what? Holding costs or inventory carrying costs. There are main costs that a business pays for holding inventory in stock. Usually, a business can incur a variety of carrying costs. These costs may be in forms of taxes, may be in form of insurance. They'll also be in form of employee costs, the wages that will be given to people who will be handling them. Depreciation, the cost of actually keeping an item in storage is a cost in itself. The cost of replacing um, goods that are being kept once they become perished is a cost on itself. Even opportunity costs. So the cost that is attached to carrying comes about in what Annie was just trying to explain. Although opportunity costs are unseen, they are intangible. You may not really you may not really see them. They have a very significant impact on a firm's what profitability. So these carrying costs, if I may mention, are also um, referred to as the carrying cost of inventory. So firms usually they pay a lot of amounts of money for holding or storing this inventory before it's actually sold to their customers. So it's important to be um, calculative when you're keeping stocks. So this is one of the costs that you need to consider. There's also what we call um, so the storage costs are now explained here in depth. So these are costs that may fall with the level of working capital investment, such as we have what we call ordering costs. So it's costly to order in smaller batches. So it may be encouraged to know there are certain pricing strategies that people have put in place to ensure that when people are buying in bulk, it becomes cheaper. So ordering regularly in small amounts may be costly for a business. Okay, so there's also what we call the lost business. So when there's shortage in supplying of materials, you may lose what we call goodwill or reputation. So each time, for instance, you're in a business of selling scones or cakes, and people keep coming to your organization and they don't have it. So that cost of you not having the commodity that they need will end up costing the firm a reputation. Eventually, they'll think you are never having. Have you ever been to businesses where each time you are going to make an inquiry, they don't have it? So this cost is one of the costs that is associated to working capital, which is called the shortage cost. So you end up losing market and business for not having certain commodities. So the costs under working capital can be illustrated as follows. The total cost of working capital is simply a combination of the current costs and the shortage costs. Collectively, they make up what we call the total cost of working capital. We've discussed the kinds of carrying costs and we've discussed the types of shortage costs that are associated. So shortage costs, we talked about ordering cost, loss of business reputation, cost of running out of stock, cost of running out of cash, going concern, disruption in production, time and cost of alternative sources of finance. So this equation can be formulated down later on as we'll discuss. So there are two types of finance for working capital. There's what we call short-term and long-term finance. So the short-term finance is used to finance what are called fluctuating current assets. So current assets are easily convertible into cash. So when we're dealing with working capital, there is what we call short-term finance, which is mainly categorically used to meet the fluctuating current assets. Then we also have the long-term finance, which is used to finance the following: the fixed assets and the permanent current assets. Permanent current assets. So the topper segment of the current assets, current assets are in the balance sheet, typified in liquidity order. So under the matching approach, we have the two types that I've mentioned as long-term and short-term. So when we go to our quiz, there was a question that was asked regarding specifically statements that are true regarding the strategies on working capital. So strategies for funding working capital include the matching approach, the relaxed approach, and the aggressive approach. Which of the following statements is true? Number one, in the matching approach, short-term finance is used to finance part of the permanent current assets, whilst in an aggressive strategy, short-term finance is used to finance the fluctuating current assets only. Then part B, in an aggressive approach, maturity of finance matches the type of the asset. Then part C, in a matching approach, long-term finance is used to finance the fixed, the permanent, the current assets, whilst in the short term, it is used to finance the fluctuating current assets. So from what we've just read right now, of the three under the matching approach, we've just read that the long-term finance is used for three things. Number one, to finance fixed assets. Number two, to finance the permanent current assets. Then for the short-term finance, it is mainly used to just finance the fluctuating current assets. So this is under the strategies that are used for funding working capital. So the matching aggressive and the relaxed, we had discussed these two earlier on. What had remained was only the matching approach. So the answer is part C. The long-term finance is used for what? Fixed, the permanent, whereas the short-term finance is used for the fluctuating assets only. Okay, so we'll now go to the formula that is used to calculating um, what is called the economic order EOQ quantity. The economic order quantity is simply a level of stock that must be kept for the firm to remain economical. So it is given by EOQ to DS over H, or what has been given there. So 2 is part of the formula. A is what we call the annual demand. Some books will just put the D itself. Then the C is simply the cost of what? Placing an order. Other books will call it what is called the setup costs. And H here is what we call the cost of handling a unit or the handling costs. Okay, others they use a C there, which is called the carrying cost down there. You can use any of these two formulas. So we have an example here, then we'll go to the example in the quiz that was given. A company uses 5,000 units of stock in a year. The cost of handling one stock is 10 kwacha per annum. The cost of placing an order is 90 kwacha. What is the most economic order quantity for each order? Okay, so who remembers the formula? The EOQ is given by what?
A square root of 2
2 times what?
AC
AC.
A, AC over what?
H.
H. So here we've been given, what have we been given? We've been given our annual demand. Okay, a company uses 5,000 units of stock a year. So our annual demand is 5,000. So this is the 5,000 here. Then we've also been given what we call our carrying cost, the cost of placing the order, which is 90. So we put 90 there, divided by the cost or the holding cost H, which is 10. So we put 10 there. So our Q is equal to the square root of 2 times A C over H. So when you calculate this, it gives us what? 300 units. So this is how much each order must be for us to be economical. So we'll go to our quiz. I would want us to apply that formula on this question now here. So we are given the demand, the annual demand of the monthly demand of how much? 1,000 units per month. So for us to calculate the annual demand, we need to multiply it by what? By 12. So whenever you're given a monthly demand, our Q is equal to what? To AC or DS divided by H. So here our monthly demand is what? 1,000. But D or A stands for annual. So we're going to multiply this one by what? By 12. What is our setup cost? And what is our holding cost? So setup costs are simply costs that are associated with having to make the commodity ready. It includes delivery costs, it includes communication, etc. So our setup cost in this case is what? 60,000. Then everything divided by our handling costs, or which is also the costs associated to handling. We mentioned the storage is part of it, security is part of it. So when you divide this by 4,000, what are we getting?
After everything, we are getting 600 units.
Yes, we're getting 600 as our final answer. So this is what we call our economic order quantity. So this is what we call our economic order quantity. Okay, we've already answered this part of the quiz. Now, according to what we've discussed so far, which one of the following do you think would be an advantage of holding high levels of stock? We've talked about the disadvantages associated with holding high levels of stock, but from here, what do you think could be an advantage of holding high levels of stock?
Continuity of supply.
Yes, continuity of supply. Like we said earlier on, holding stock can be advantageous and also disadvantages at the same time. So disadvantages are the costs associated with what? Security, keeping the stock, the risk of the goods being what? Outdated, expired, and also other costs of handling. But again, it is important to level up on the quantity of stock that you're keeping as a firm, because if you don't have stock, you end up having what cost? The shortage cost. And the shortage cost has a lot of associated um, setbacks in production. For instance, it will delay production. So this one at least will ensure the continuity of production. So once you hold cost, it also necessitate continuity of supply, because each time customers will come, they have something to buy. In the long run, it will avoid what are called the stock out costs. This is a cost that is associated with the shortage. It will also avoid you losing what is called goodwill of customers. Like I mentioned, the goodwill and the reputation of a firm is important. Always turning back customers will result in them finding the nearest alternative that would be a consistent supplier. So, in a nutshell, this is what your quiz was all about. Unless there are any questions here.
Are you going to send the recording? I joined late.
Yes, I'll send the recording.
Thank you.
Okay, so those of you who haven't attempted the quiz, you can now go ahead and attempt. Have a good evening.